How about living off dividends and reaching financial freedom? Dividends can make it easier to live off them than you might think. If you stick to your goals, you will reach them, even though it'll take some discipline and strategy. Living off dividends will allow you to retire early. However, the most exciting part is not having to do anything. You won't have to deal with co-workers or bosses. Your mornings are no longer dominated by an alarm clock, ironing shirts, or grabbing a quick breakfast. People who have to fight traffic on the highway each morning will turn green with envy when you mention sleeping in. Investing in dividends and retiring early is more than just a dream. Thousands of people have already achieved this goal. Dividends from stocks grow over time, unlike interest from bonds. For this reason, stocks should be included in every investor's portfolio. Historically, dividend growth has outpaced inflation. This is the basis for building a portfolio devoted to dividend income for investors with a long-term horizon. To save for retirement, it is a brilliant idea to use dividends to purchase more shares of stock in companies. In this way, they'll be able to buy more shares and receive even more dividends. Suppose you invested 80 lakh rupees in 1,000 shares of a stock at 8,000 rupees each. With a 3% dividend yield, you receive 200 rupees per share over the past year of 2 lakh rupees in dividends. The dividends are then taken and you buy more stock, resulting in a total investment of 80 lakh rupees. The stock price doesn't move much, but the dividend increases by 6% yearly. Dividends of 2 lakh rupees will be paid in the second year of 8 lakh rupees. That's about a 3.28% yield on cost. Over time, this dividend reinvestment strategy increases the yield on cost. Dividends produced by the hypothetical portfolio will be around 5,70,000 rupees after 10 years. You will receive more than 19 lakh rupees in dividends every year after 20 years. The benefits of compounding dividend income are evident if you have a long-term horizon. But what if you're close to retirement? These investors might benefit from dividend growth plus an increased yield. First, retirees who want to live off their dividends may want to increase their yield. The distributions of high-yielding stocks and securities such as master limited partnerships, REITs, and preferred shares are generally not growing much. Investing in them, however, increases your portfolio's yield. It'll go a long way towards paying today's bills without selling securities. The following are some strategies you can use. Number 1. Define what retirement means to you. Imagine what your early retirement will look like as a first step. What kind of lifestyle do you plan to lead? In what places will you travel? Where will you eat? Can you tell me about your hobbies? It is important to consider your health and that priorities may change over time. The better you define your vision, the more likely you will be to succeed. You will also need to estimate your annual income to fund this lifestyle. Number 2, figure out how much you'll need to save. To prepare for retirement, estimate how much money you'll need. After subtracting any government or employer benefits, multiply your estimated annual expenses by 25. Let's say you need 28,49,000 rupees a year to maintain your lifestyle. You'll have to save somewhere around 7,12,30,000 rupees. Number 3, take inventory of your finances. List all your sources of income next. Then list your fixed expenses like mortgage, utilities, insurance, etc. and your variable expenses, entertainment, dining out, vacations, etc. Keep your spending under control if you want to retire early. Your budget needs to be cut to eliminate unnecessary expenditures. The daily latte? Probably it's a good time to get rid of that. How about a weekend at the movies? It would be cheaper to subscribe to Netflix. BMW lease? A Volkswagen should do the job. There is no doubt that you need to have some fun in your life. As you trim your budget, you add more money to your nest egg and spend less time working. Number 4, invest in income-producing assets. Early retirees should consider dividend stocks for 2 reasons. Historically, they have provided the highest investment returns of any asset class. Your nest egg will grow faster the faster you can retire. Dividend stocks pay higher yields than checking accounts and fixed income investments. Retirement will eventually require an income stream. 3. Most companies raise their payouts at or above inflation. Over time, this provides built-in protection against rising living costs. Savings can also be made on other assets, such as rental properties. Due to the hassle of dealing with tenants and my preference for diversification, I avoid real estate. But if you have experience in different industries, these asset classes could be better options. Number 5. Focus on growth, not yield. Income investors often buy securities with the highest yields. Big mistake. High yields are often a sign of troubled businesses with unsustainable payouts. Losses can be painful and unexpected as a result. The most effective strategy is to focus on small, fast-growing dividends that compound into impressive income streams over time. Even a dividend trickle can become a raging river of cash flow with enough time. Suppose you bought 1,000 shares of a stock for 8,000 rupees for a total investment of 80 lakh rupees. Since the stock has a 3% dividend yield, you received 2,50,000 rupees in dividends over the past year. Dividends are then taken and more stock is purchased, resulting in a total investment of 83,40,837 rupees. Suppose the company increases its dividend by 6% a year, but the stock price doesn't move much. On 83.4 lakh rupees, you'll get a dividend yield of 3.18% for a dividend of 2,65,206 rupees in the second year. That is a yield on cost of about 3.28%, however. Number 6. Dividend ETFs. When it comes to dividend stocks, finding the right ones can be challenging. For small investors, achieving sufficient diversification is even more challenging. Fortunately, you can invest in ETFs that employ dividend strategies. Stocks with dividend growth potential are the focus of dividend growth ETFs. If you're looking for current income, you should invest in high dividend yield ETFs. Some of the best dividend ETFs may include Nippon India, Wisdom Tree, Nifty India Financials, and iShare MSCI India ETFs. Dividend investing strategies can be implemented across stocks and funds with the money you set aside. ETFs and mutual funds that pay dividends offer low fees, immediate diversification, and simplicity. Investing in funds is generally a set-it-and-forget-it endeavor. However, investors lose a valuable benefit: control. There are dozens, hundreds, or even thousands of stocks owned by most funds. For example, Vanguard's High Dividend Yield ETF, or VYM, owns over 400 companies. Others are low in quality and will cut their dividends during the next downturn, while some are reliable businesses with safe dividends. Some generate high yields and others generate no income at all. Funds are a collection of companies that may or may not match your income needs and risk tolerance very well, particularly when the tide turns. Due to its lack of dividend safety, Vanguard's High Dividend Yield ETF got into trouble during the 2007-9 financial crisis. Dividend income dropped by 25% during this period, and it took 4 years to recover. Additionally, most funds pay variable dividends that fluctuate unpredictably each month, making it difficult to forecast your income. If you don't want to avoid funds for the reasons outlined above, picking your dividend stocks will allow you to adjust the amount of risk in your portfolio. Doing this will give you a more accurate picture of your income. Most companies pay dividends quarterly or monthly. Each stock will tell you exactly how much you'll receive and when. Focusing on dividend safety can also result in higher and faster growing income than most funds. You'll be better prepared for the next downturn with a better understanding of your investments. Here are some general guidelines we like to follow when building a portfolio. Number 1. To reduce company-specific risk, hold between 20 to 60 stocks. Number 2. Each position should be equally weighted since it is difficult to predict which companies will be the best long-term performers. Number 3. You should not invest more than 25% of your portfolio in one industry. And number 4. Dividend safety scores of safe or very safe companies should be targeted. Living on dividend income in retirement comes with several risks, however, so you need to consider some risk factors and avoid common pitfalls. When you follow dividend strategies, you may be tempted to purchase mostly high-yield stocks, which provide the highest income today but are concentrated in a few industries, such as real estate investment trusts or RDITs, master limited partnerships or MLPs, and utilities. Insufficient diversification may make a portfolio more sensitive to rising interest rates if it bets heavily on these areas. Additionally, it may be more vulnerable to adverse industry developments. In addition, it may generate returns that are different from those generated by the broader market. Besides REITs and MLPs designed for higher dividends, companies with high yields can signal structural problems. It is also necessary to cut the dividend. These situations can result in a permanent loss of capital. Besides chasing yield, Dividend investors can also fall victim to hindsight bias. Stocks like the S&P 500 Dividend Aristocrats have become popular with investors due to their desire to own consistent dividend growers. A dividend aristocrat is a stock in the S&P 500 that has increased its dividend for at least 25 consecutive years. Dividend investors pay attention to these stocks because they have outperformed the market. It is a common assumption that they'll continue to pay dividends and grow, but that is not a guarantee. During the financial crisis, 16 of the 60 dividend aristocrats cut or suspended their dividends. Bank stocks accounted for most of those cuts, but it's difficult to predict which sector will be affected next. The pandemic served as a reminder that dividend income is not risk-free. Dividends were cut by 25% of companies covered by our Dividend Safety Score TM. That is 333 out of 1,313 in 2020 as the US economy experienced its sharpest contraction in history. This doesn't invalidate a dividend investing strategy, but rather highlights the importance of owning companies with solid balance sheets and time-tested operations. These businesses are more likely to remain profitable in good and bad times. It can be overwhelming to manage your retirement assets. Your decisions will depend on your current financial situation, long-term goals, risk tolerance, and quality of life expectations. Review the fees, flexibility, and fine print when considering investment strategies. Whether it's bond interest, annuity payments, asset sales, or dividend income, your objective is to generate consistent cash flow. Dividing stocks can provide current income and total return for a retirement portfolio. To make a retirement portfolio last a lifetime, dividend stocks must provide safe current income growth, and long-term capital appreciation. Safe dividends help investors generate safe dividend income from dividend-paying stocks. You might be interested in our online product, which allows you to track your portfolio's income, dividend safety, and more. For more details, refer to our video, Why These 6 Dividend Stocks Are Poised for Beautiful Upcoming Returns, Investment 2023. The link is given in the description below. That's it for today. Please remember we are putting stats and info in front of you, which is based on the previous performance of these stocks. This is meant for educational purposes only, so we aren't responsible for any profit or loss. You can have proper financial consultation before investing. So what do you guys think about this video? Please share your reviews about what you think and let us know what investment strategy you would be adopting that can help you beat the stock market. Hope you liked this video. If you did, remember to like, share and subscribe. Stay tuned as we will come up with many more new and more informative videos. Till then, goodbye.